speak to the team at Coinbase, speak to any of these people. I don't see any of these people saying it's all over. They're all saying it's all coming. Because don't forget, if you're at Coinbase, you know the pipelines of institutions who are going to use your rails to tokenize. If you're Bitwise, you know what the RIAs are thinking, the endowments are thinking, the pension plans are thinking. You know the lead time it takes. It takes a long time, but they can see visibility of their pipeline. They know how price sensitive those people are, so they can weight the probabilities of who their customers are going to be. And Coinbase can do the same. We haven't had the Clarity Act yet. Once that comes, it kind of is like, okay, it's now free reign.
If you've been watching the markets closely, you might be feeling that familiar mix of frustration and excitement. Crypto has been range-bound. Macro conditions are shifting, and yet something tells me, and Raoul Pal agrees, that the next chapter for this market is going to be explosive. Pal, a seasoned macro strategist and founder of Real Vision, isn't talking about the end of the bull market. He's seeing the beginning of something much bigger. Speaking with insiders at Coinbase, Bitwise, and other leading crypto firms, he points out that the pipelines for institutional adoption are massive, that liquidity is about to surge, and that 2026 may become the year where crypto finally accelerates beyond what most people expect. Think about that for a moment. If you're skeptical, you're not alone. But Raoul's analysis isn't speculative hype. It's based on what these firms see every day: endowments, pension funds, and institutions quietly preparing to move, coupled with the upcoming regulatory clarity that will unleash even more market activity. And here's the kicker. The final liquidity squeeze of 2025, while painful, may have been exactly what was needed to set the stage for an extraordinary 2026. So before we dive deeper into the numbers and predictions, I want you to think, are you positioning yourself to benefit when this liquidity flood hits? Drop your thoughts in the comments, because we're about to unpack exactly why institutional investors have become super bullish for 2026. Quick favor before we dive in. More than 80% of viewers come here without subscribing. If you find value in this kind of thoughtful, long-form analysis, hitting subscribe helps keep this channel going. You'd be directly supporting the work we do. And honestly, it helps make this season and the year ahead a little better for us. We truly appreciate it. Happy holidays and enjoy the video.
Is your advice in December 2025 still to buy the dip?
Yeah, and I think we had the final low. So we had the October liquidation. So liquidity got withdrawn by the US government via the Treasury General account. We had an air pocket of liquidity from that. And then they shut down the government. And then now there's no liquidity because they can't even spend the TGA. So what happened was crypto, being the most liquidity sensitive, nuked and exposed all the weaknesses of leverage that you and I know so well. The whole thing nukes and it triggers this, issues with how the system calculates leverage and stuff. Okay, fine. We rally back. We've come back down. Some of them went through it. Some of them didn't go back through that low, but we're kind of basing around those levels. And then suddenly out of nowhere today, things are up 20%, 30% in a day. And you're like, okay, the signal's probably there. So the dip zone, again, nobody needs to buy the absolute bottom, but that dip zone has been forming from November, because after October, we had the November pullback, and then into the end of November, we had the final sell-off, and somewhere here feels like it's there. Now, looking forwards, if I'm right in all of the work that I do about liquidity, we've got a flood of liquidity coming. So right now, the system is telling us the banking system is constrained, and it keeps causing spikes in money market stuff. There's not enough money around. The Fed know it. They stopped QT. Okay. One job done. But the other job is they've got to get through year-end funding. There's not enough liquidity for the banks to roll their debts and to do their balance sheet work. So the Fed are going to have to inject some liquidity. It'll be some 3-letter acronym based in the repo market or whatever, but they have to do it. But they made a huge announcement that most people don't understand, which is the ESLR, another nice acronym. The supplementary leverage ratio means nothing. They never do these things. What they've basically said is what we used to say, US Treasuries carry this much risk. And so on your balance sheet, we're going to penalize you for holding them. But then the less risky asset, so they've got this tug of war with the banks of what they want to do. And they've just said, you know what? We're going to shrink how much risk you have to put on your balance sheet by owning treasuries. What does that mean? It means the banks will buy a lot of treasuries, which is what the government needs to do, is sell treasuries. That's their job right now. So the banks can use treasuries. You're hearing Scott Bessent saying, we want the money to flow to Wall Street, Main Street, and not just Wall Street. What he's saying is, we don't want the central bank to do QE. Every moron on Twitter goes, see, they're tightening. They don't want anything. What they're saying is, oh, we're going to let the treasury print money instead and stuff it down the necks of the banking system. And the banks, being so good at what they do, lever it up and lend it out or provide liquidity. So the entire apparatus of managing the debts is moving from the Fed to the government. So the government creates its own buyer for its own treasuries. It's an easier way to debase currency. But the ESLR changes are important because the system's screwed up because of these changes after the financial crisis. So that was announced, rushed through, because I've been writing about it and I was like, they'll announce it sometime in Jan, Feb that they're going to implement it. No, came through, straight out, done. We've agreed it with the banks. We're doing it January 1st. I'm like, wow. So that tells you they understand the game. The moment it was announced, and Steve Mirren had been pushing this thing through, the moment it was announced, Steve Mirren published another paper that day and said, good job, not enough. We need to reduce all risk weighting on treasuries. So 100% no risk for treasuries. So now there's an unlimited purchasing of bonds that can happen when needed. And you can really expand the money supply. And that, because it's credit, ends up going to ordinary people. They also buy more bonds, which lowers the long end of the bond market, which lowers the mortgage rates, lowers the government funding. It's a big deal. We're talking, this is going to end up being 3 to 4 trillion, maybe 3 to 5 trillion of extra liquidity. Oh, and then we've got rate cuts. Oh, and then on top of that, we've got $1.5 trillion probably in direct banking system deposits coming out of the new stimulus. I mean, don't forget, every single service worker in America gets paid on tips. They're all zero tax. So you're freeing up a ton of disposable income, mortgage rates come down, all of that. So that unleashes the business cycle. So you've got a lot of liquidity things happening all at the same time. In the middle of that, you've got the Clarity Act, whether it comes end of this year or by mid-Jan, it's coming. And that allows everybody to use crypto because it will have been defined on how to use it. So we've got an extraordinarily powerful year ahead of us. We've had to go through the hard part, which was this liquidity squeeze, but that will give us what we want going forwards. We then get the explosion of stable coins. This explosion of stable coins allow the government to issue more bonds because we've got these new holders who could be anybody in any country now are basically owning government bonds via stable coins. So the money is coming to roll the 10 trillion of debt. Meanwhile, the Chinese are printing money. Their balance sheet's increasing. The Japanese are doing massive fiscal stimulus. And so the game is on. Speak to the team at Coinbase. Speak to any of these people. I don't see any of these people saying it's all over. They're all saying it's all coming. Because don't forget, if you're at Coinbase, you know the pipelines of institutions who are going to use your rails to tokenize. If you're Bitwise, you know what the RIAs are thinking, the endowments are thinking, the pension plans are thinking. You know the lead time it takes. It takes a long time, but they can see visibility of their pipeline. They know how price sensitive those people are, so they can weight the probabilities of who their customers are going to be. And Coinbase can do the same. We haven't had the Clarity Act yet. Once that comes, it kind of is like, okay, it's now free reign.
So as a recap of what we talk about today, how do I make it in crypto in 2026?
Hold the right assets and do nothing. And don't rent conviction from people. Do your own work. And then you'll find your own conviction. And that's a really important thing. And don't look for a low price in terms of unit cost and then find a echo chamber of narrative that comes around that. We've all done that in the past. Just openly look at the space and say, how much risk am I prepared to take? What is my goal here? Am I trying to compound wealth or am I trying to get my starter pack of money to play the casino with? I get that speculative side, but you can do it in a smarter way and just have a time horizon that is realistic. And looking at it 3 months, 1 month, 9 months, 1 year still doesn't make sense. My entire thesis is the length of the cycle. I think the length of this cycle is 5 years. I changed my view. I thought it was going to be 4 years, but my forward-looking indicators kept pushing out. And I'm like, why is this happening? And then I realized that the debt. And so 5 years is my time horizon. Everything else is just noise.
Now, let's get a sense of why all this matters on a practical level for investors. Raoul highlights the final dip in late 2025 as a perfect example of how liquidity events can shake out the weak hands and create opportunities for serious buyers. But let's be real, this isn't just about timing the bottom. It's about understanding the mechanics. When liquidity flows, when institutions step in, and when government policy subtly shifts to support markets, opportunities compound in ways most retail investors fail to anticipate. Other market veterans, from ARK Invest to Galaxy Digital, echo similar insights. They're watching these pipelines, analyzing leverage, and positioning for the systemic tailwinds that could drive crypto multiples higher. This isn't theory, it's being built in real time by the very people who control market-moving flows. And that brings us to a question every investor should be asking themselves. Are you ready to ride the next wave, or are you stuck waiting for the perfect entry that may never come? Let's get back to Raoul Pal's analysis.
Isn't the way to make true money in crypto just dollar cost averaging Bitcoin forever?
Yes, but I would say even better is to weight your dollar cost average to when the market's down X%. Let's say down 30% or more, you do 3 times as much dollar cost average as you do when it's making new highs. You will definitely compound better. It's not that difficult to do. I don't even think about this shit in the end because once you've been around the market long enough, you realize you don't remember a single one of your entry points.
Yeah.
Not one. You don't remember when you were the hero buying the dip, unless it was the dippity dip. If not, you don't remember it. And you don't remember when you blasted a local high because it doesn't matter. You look back in the chart, it's like, who cares?
Oh, you remember buying Bitcoin at whatever, 10K before it went to 3.5K during a March crash, and you're still up 10X, right?
So, I know. It's really
and you were
hard
down 80% in
and you were
2 days.
probably swearing at whoever you followed into that trade on X, calling him a moron and a scammer and a cheat and a liar, right? And it went down to 3,500. See that guy? He ruined my life, and you're now up 10X from the entry price. It's like, this is the thing people don't understand in crypto. Time is everything. It's also, its signal to me is when I'm not communicating things clearly enough. I try really hard to communicate things clearly. And if I'm seeing that people are like, you told me Sui would go up because on that podcast, you said it was going up and then it went down. You have to kind of explain to people time horizon, the dollar cost averaging idea. Are you in the right part of the risk curve for you? Do you understand what you're buying here? Do you understand you're buying an earlier stage token that has a risk that it doesn't get network adoption? Do you know how to spot if it's got network adoption? If you don't, move to Bitcoin. If you do, even everybody became ultra moronic on ETH, saying ETH's going to die. I'm like, the thing with the deepest, largest amount of active users, wallets, businesses built. I mean, 6 months ago, 9 months ago, people were like, well, ETH's going to 1,000 and below and it's all over. Because people were just following a narrative and not actually just looking at the reality of it. My view on this is, and I keep saying it, is we're a $3.5 trillion asset class today. Just take the trend rate of growth of the market cap in a log regression channel and you get to 100 trillion in 10 years. And that's even assuming some slowing. So it doesn't go to 2 standard deviations overboard. Just some slowing of the trend, you get to 100 trillion. So we're only 3% of the way there. Then let's go back to, okay, Bitcoin dominance will fall over time versus smart contract dominance, which will rise because smart contracts have more use cases. That's not a diss against Bitcoin. It's just the applications layer is so much larger than the collateral layer, which is called Bitcoin, the collateral layer of the economic system. If you think of the collateral layer of the economic system, it's US treasuries. Then you look at the entire leverage of everything built on top of it, it's much bigger. So it's the same with this. So that layer over time will outperform. And so just making sure that you have enough of that exposure to capture this 3 trillion to 100 trillion, because it's not all going to be Bitcoin. That's actually the hard part. It's actually a little bit difficult to do because just buying ETH doesn't necessarily do it. But so the trade is still there.
Yeah.
Right? There's still a 30x in the entire market cap of the space, a 33x. That's monstrous. So what does it mean for some of the winning tokens? Not 1,000x's all over the place. So what people don't understand, there's a fight going on X right now about this, and Seeb's part of it. There's the Metcalfe's Law network model people like myself, Seeb, and then there's others who want to use discounted cash flows and other analysis to pick up cheap businesses and be the Warren Buffett of crypto. It has been proven time and time and time again is network models outperform everything you've ever seen before. And it compounds because the more valuable a network is, the more users it brings, the more value it brings onto the network, the more it goes up. And this thing compounds exponentially over time. And people say we should be valuing Ethereum based on its fees. That doesn't get what it is. This is not a company that earns revenues. This is a network that enables an entire group of businesses to build upon it, all sorts of value chains. And how Metcalfe's Law works is you capture the total value and the number of people driving that value. So you get this kind of unit value per person. So you know if you bring a new person onto Ethereum, they're worth $313,000. That's currently the math. While on Solana, it's about $65,000. Now, it's a bit skewed because the layer twos are accruing as well, but basically that's what it is. So you kind of know that every new user you bring onto Ethereum, the value goes up a lot and can go up even more as more people build more businesses on it. And people forget that compounds. Discounted cash flows don't compound, not in the same way. Because again, Metcalfe's Law is the number of users, total value transacted. So if right now we have to open a Coinbase account, we have to do this and we have to do that, fine. It's restricted to whatever the number is. People say there's 650 million wallets right now. Okay, great. Put it on every mobile phone in a simple format on every Apple wallet or whatever it is. You've suddenly got 5 billion people. They transact the same amount of value per person. Holy shit. I mean, it's really simple once you understand it. So yeah, the more access there is, the more people join it, the more value gets transacted on it.
Yeah. Just believe in something, guys. That's it.
No, but people believe we can't have nice things because they're too short term. So it's like, it's over. It's oh so over and we're so back. It's such a prevalent mindset that it happens almost on a daily basis. It's so over, we're so back that people forget this stuff compounds over time because they don't have time horizon. You know, you and I have talked about this almost every time we've ever spoken, and yet people don't listen.
To understand the scale of what Raoul Pal is seeing, we have to look beyond just Bitcoin and Ethereum's price charts. Leading crypto firms and their analysts are increasingly bullish across the board, citing institutional pipelines, rising stablecoin adoption, and regulatory clarity as catalysts that could push trillions of dollars into the market. Recent forecasts from Bitwise and Grayscale provide further confirmation of this unprecedented bullish outlook. Bitwise's Matt Hoogan highlights that traditional drivers like halving, interest rates, and leverage are losing relevance, replaced by a new era defined by institutional capital and regulatory clarity. Major financial institutions such as Morgan Stanley, Wells Fargo, and Merrill Lynch are expected to join the crypto ecosystem next year, pushing Bitcoin toward new historical highs. Bitwise also notes that Bitcoin's volatility has become lower than that of major tech stocks like Nvidia, suggesting a maturing asset class that could continue to decouple from traditional markets. Grayscale echoes this sentiment, projecting record highs in the first half of 2026, fueled by global demand for alternative stores of value, the adoption of stablecoins, tokenization, and DeFi growth, all underpinned by regulatory developments like the Clarity Act. Consider the implications. If Bitcoin eventually catches up with gold as a global store of value, we could be looking at multiples that dwarf previous bull runs. Ethereum's network, driven by utility and adoption, compounds in a way that traditional discounted cash flow models cannot capture. The growth isn't linear, it's exponential, fueled by both user adoption and the deeper integration of crypto into traditional finance channels. This is exactly the type of market environment Raoul highlights when he talks about "it's all coming" and the pipelines are visible. With regulatory frameworks clarifying and institutions preparing to deploy massive capital, we're looking at a convergence of tailwinds that could make 2026 one of the most structurally bullish years in crypto history. But it's not just about price, it's about strategy. Pal emphasizes holding the right assets and doing nothing rashly, building your conviction independently, and understanding the full cycle, which he sees stretching 5 years. For serious investors, this is a time to position thoughtfully, dollar-cost average strategically, and consider the exponential potential of crypto networks. So, what's the takeaway? 2026 may not just be bullish, it could redefine the scope of what the crypto bull market looks like. Institutions are gearing up, liquidity is poised to explode, networks like Bitcoin and Ethereum are laying the foundation for exponential growth, and regulatory clarity will open the floodgates for mass adoption. If you want to be ahead of this wave, now is the time to understand the signals, position strategically, and build conviction from independent research. Drop your thoughts in the comments below. What's your take on these forecasts and the upcoming liquidity and adoption tailwinds? And if you found this analysis valuable, make sure to like, subscribe, and hit that notification bell so you don't miss the next breakdown. Happy holidays, everyone. Stay bullish, stay merry, and see you in the next video.